If I would have converted all my cash flow, just my free cash flow from my real estate for the past 12 years, when I got my first Bitcoin, I was distributed about 1.6 million. See, I don't mind telling people what I was distributed. Let's say it was 1.6 million a month, every month for the last 144 months, whatever that number is. Let's just take 1 million for simple math. That would have been $144 million, which I had it in my hand. Half of it was not taxed because the first 5 or 6 years is not taxed. And if I would have just converted that cash flow into Bitcoin, it'd be worth $40 billion today, even with the pullback. And I'd be one of the richest men in the world.
A $1 million net worth sounds impressive until it's broken down into monthly income. Without cash flow, even 7 figures can quietly erode over time. The real wealth equation isn't about what you own, but what consistently pays you and where you deploy it. Grant Cardone, real estate investor and founder of Cardone Capital, presents a capital allocation strategy that merges income-producing real estate with the asymmetric upside of Bitcoin. His exposure to Bitcoin began in 2013 when he accepted 115 BTC as payment for a speaking engagement. Initially skeptical and unfamiliar with the white paper or prominent advocates such as Michael Saylor, he held the asset and later recognized its exponential appreciation potential. Cardone's framework shifted from viewing Bitcoin and real estate as competing stores of value to integrating them within a single structure. In one transaction, he acquired a $230 million property from Blackstone at a substantial discount to replacement cost and layered $100 million in Bitcoin onto the balance sheet. The structure preserved cash flow while introducing a high-growth digital asset, creating dual exposure, stable yield from property operations, and upside volatility from Bitcoin. When one asset appreciates significantly, liquidity can be harvested while retaining the other. He argues that traditional REIT frameworks, established in 1965 and required to distribute 90% of income, cannot hold Bitcoin on their balance sheets. This structural limitation excludes trillions in institutional real estate capital from direct Bitcoin ownership. By operating outside that constraint, Cardone positions the hybrid model as a new financial instrument. His broader thesis centers on income. A $1 million net worth without cash flow equates to gradual capital depletion. Sustainable wealth, in this framework, derives from consistent income streams strategically converted into appreciating assets like Bitcoin. If income is the engine and Bitcoin is the accelerator, the real question is how you're positioning your capital for the next decade. Share your strategy in the comments, pass this along to someone building wealth, and subscribe for more insights on income, assets, and smart capital allocation. Now let's enjoy the interview.
I'm extremely conservative. So I was given my first Bitcoin in 2013. I was given 115 pieces. I didn't know what it was. I said, look, is this going to make me sick? Is there something bad going to happen? The only way they could pay me for this event was in Bitcoin. So I said, look, I'll take it. I don't know what it is. I took the 115 pieces, still have them today. So it was probably the best speaking gig I've ever done, about 11 million bucks. Maybe not, maybe $7 million now, because of whatever's going on. And then I started playing with it because I didn't read the white book,
white paper,
the white paper or the Bitcoin standard. I didn't know who Michael Saylor was. And so I just took it and watched it. And then I started playing with it. Every once in a while I'd buy some or, buy a piece. And then last year, I said, what if I could start combining real estate and Bitcoin together? Because I was on a debate. You might have been on that debate on Space.
I remember.
It was what's better, Bitcoin, real estate, or
gold?
Gold. And I said, well, I don't think it was gold, actually. I think it was something else. Anyway. And so last year we bought a $230 million asset from Blackstone. It was $130 million below replacement cost. Instead of stealing the real estate, simply stealing the real estate, we said, hey, we bought discounted real estate, and a discount is invisible. There's really no value in a discount except that it's a lower price. You had a lower entry. But when you sell it, all you're going to do is make the difference. between what you stole it at and what the market value is. Well, instead of just taking the discount, I already have $5 billion worth of real estate. We just stacked $100 million of Bitcoin on top of it, and I'm still cash flow positive, and I'm still below replacement costs. Now, the benefit of that is that when I go sell my real estate off, or I sell the Bitcoin off, I still have one of the other assets. So we did this. I brought it to my audience. I said, look, I just bought an asset that was $230 million. It should have sold for $350 or $360. I stacked $100 million on top. Now I'm at $330. I'm going to get a loan for about $130 million, so I need to raise $200 million. I funded it off my balance sheet. I've been doing this for 6 years now. I buy it, and then I tell my audience, I fund it on my balance sheet, and then we backfill it. I introduced it to my audience. These are not Bitcoiners. These people do not know what Bitcoin is. They don't know who Michael Saylor is. They don't know this dude. Okay, they're not in this event. They don't even know this event's coming here. They don't know what a coin or a token is. And I had 1,500 people invest with me that have never invested in Bitcoin. They invested because the two were together. I had half the audience did not invest with me in real estate, and they've been watching me for 20 years. But because I put the two together, it became a more attractive investment for them. There's a REIT industry, real estate investment trust, for the audience. There's 190 REITs. They're underperforming, and they can never hold any currency on their balance sheet. They have to distribute 90% of their money. So we basically stumbled into a glitch. There's a glitch in the universe where the real estate investment trust, they have $4.5 trillion worth of real estate, can never, ever own Bitcoin. Starwood, Blackstone, all of them, none of them. The insurance companies that own a majority of the commercial real estate in America is owned by New York Life, the MetLifes. People don't even know that. Can never, ever have Bitcoin on their financial statement. The syndicators, people like me, I'm considered a syndicator in real estate, okay? Most of them are having trouble raising money for their real estate projects, much less the real estate and the Bitcoin. So by me raising money for institutional, best in class, this is as good a real estate you can buy. We just bought this monster deal in Boca Raton from Blackstone out of bankruptcy. When we start stacking those together, and all those properties now are branded Bitcoin properties called 10X brand. It's a brand that we have, and we have the combination of the real estate and the Bitcoin. We think we create a new vehicle, a new financial instrument.
So you think you can take the real estate and the Bitcoin and put it in a REIT structure?
Yeah, it won't be a REIT structure because the REITs are required. REITs have not changed since 1965. They were created for a real estate hack, for a tax hack, and they haven't changed in 65 years. So I think I'm going to be able to exploit and disrupt the real estate investment trust industry.
Outsiders, not insiders, drive new markets, and combining income-producing real estate with BTC and ETH can create unprecedented wealth. Grant Cardone argues that new markets are built by outsiders, not incumbents, pointing to cities like Scottsdale and Miami where incoming capital accelerated appreciation. Applying that framework to BTC and ETH, he contends that broader adoption, not insider cycle analysis, ultimately drives expansion. The emphasis is long-term capital preservation and scalable growth rather than short-term volatility tied to having narratives. He challenges messaging that positions BTC as a replacement for the US dollar or for income-producing real estate. Real estate generates predictable cash flow and satisfies structural demand for housing, while BTC and ETH function as high-upside digital assets layered onto productive capital. The strategy centers on converting earned income into appreciating stores of value, not liquidating foundational assets for speculative concentration. Cardone also underscores capital allocation discipline. Redirecting consistent free cash flow into BTC over the past decade, he notes, could have produced exponential outcomes. However, his core doctrine prioritizes building a reliable, cash-flowing enterprise first. Young investors are advised to develop skills, brand equity, and a primary income engine before accumulating BTC or ETH. Digital assets become powerful accelerants only after financial infrastructure is established. Sustainable wealth, in this model, flows from income conversion, asset stacking, and disciplined long-term positioning. Let's get back to the interview.
in real estate, we always say the outsiders make the market, right? Like new people come into a market and they make that market. The people that lived in Scottsdale, Arizona didn't make the Scottsdale market. Okay. The people that came in from California made that market. So New Yorkers are making Miami now, like Chicago's making Miami. Miami didn't make Miami. Outsiders make new markets. Okay. So a guy like me comes along, not paying attention to what you guys are doing. And boom, the next thing you know, I see the thing different than you see it. You see all these dips at 7 years, some bullshit 4-year cycle that y'all talk about obsessively that nobody can explain to me.
Well, every 4 years it goes down.
Whatever. I'm like, dude, I ain't in it for 4 years. So I think that the Bitcoiners y'all need to learn how to talk to people different. You know, a third of the audience is, you know, US dollars going to zero and this is going to replace money and the dollar is going to go away. I'm like, I don't want to hear all that shit. It's all depressing to me, you know?
So what do you want to hear?
And Bitcoin's going to solve every problem in the world. And there'll be no pedophilia because of Bitcoin and water problem. I'm like, fucking, dude, I just want a good investment. Like I can't deal with all these other problems that you're dealing with. I'm simply trying to convert my hard work to a good investment that I can pass on to the next generation. That's all I care about. The rest of this stuff is crazy making to me. So what do I want to hear about? I just want to hear everything's going to be all right. You know, and talk to me about the things I understand and agree with. Okay. Like I hear people in these spaces talk about how Bitcoin's going to replace all the real estate. Okay. And it's like, yeah, no, dude, I still need a place to live. I got people online telling me I should get rid of $5 billion worth of real estate that took me 20 years to accumulate. You should get rid of all of it and all the other companies you own, and you should only own Bitcoin. I'm like, fuck, you're fucking crazy. Now, if I would have converted all my cash flow, just my free cash flow from my real estate for the past 12 years, when I got my first Bitcoin, I was distributed about $1.6 million. See, I don't mind telling people what I was distributed. Let's say it was $1.6 million a month, every month for the last 144 months, whatever that number is. Let's just take $1 million for simple math. That would have been $144 million, which I had it in my hand. Half of it was not taxed, because the first 5 or 6 years is not taxed. And if I would have just converted that cash flow into Bitcoin, it'd be worth $40 billion today, even with the pullback. And I'd be one of the richest men in the world. Instead, I'm up here in a fucking hot room.
So
I own 3 stocks and they're all relationship investments.
Okay.
They have nothing to do with the stock.
Okay. So, yeah. But why not any stocks?
I'm not a paper guy. You know, I got a piece of paper. I'm like, why would I go sideways and convert to another piece of paper? I want to convert to something better than paper. I've always been like this. I've been doing this 37 years. Get a piece of paper for somebody, take paper, convert to something better. And in the beginning, it had to cash flow. If it didn't cash flow, I wouldn't do it because I needed a second drip because I didn't think I would last this long. Okay. I was 30 years old selling shit. And I'm like, there's no way people are going to keep buying shit from me. Like, how many times can I do this before people are like, no, we're not going to buy anything from you again. But I grew up poor. So I grew up in raised by a single mom. And, you're just waiting for the wheels to fall off all the time. Like my dad died when I was 10. My older brother died when I was 20. And when you're brought up and you have these losses, then you're like, the wheels are going to fall off again. I was brought up by a woman that was raised during the 1920s. So she had this 1932 depression mentality, food lines, the whole deal. And so the psychology of how you're brought up affects how you invest. And that can be good and it can be bad.
Integrating income-generating real estate with high-upside digital assets such as BTC and ETH provides a dual-layered approach to wealth accumulation, balancing stability with asymmetric growth potential. Discounted real estate acquisitions preserve cash flow while offering tangible value, and layering digital assets on top introduces exposure to markets with exponential appreciation. Traditional REIT frameworks and institutional limitations restrict direct Bitcoin holdings, leaving opportunities for alternative structures that combine these asset classes. The model emphasizes disciplined capital allocation, prioritizing a primary cash-flowing enterprise before converting surplus income into digital assets. Historical analysis suggests that consistent allocation of free cash flow into BTC could have yielded significant wealth creation, highlighting the importance of strategic timing and long-term positioning. Outsider-driven market expansion demonstrates that adoption and capital inflow, rather than insider cycles or volatility, are primary determinants of market growth for digital assets. Aligning foundational real estate with digital currency exposure creates a scalable framework that captures income, preserves capital, and leverages emerging asset classes, enabling investors to construct portfolios with both predictable returns and high growth potential. If you had a steady cash-flowing business today, how much of it would you convert into BTC or ETH for long-term growth? Transforming income into BTC and ETH could redefine wealth building. Share your thoughts in the comments, pass this on to fellow investors, and subscribe for more insights on smart capital strategies.